Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans themselves. The long-term construction of a bearish pattern continues. Initially, this had been in the form of a somewhat sideways rectangle pattern. However, it now seems that this market is veering more towards a shallower bear channel, currently 1489 to 1670. The most recent dip lower was as a reaction to the market's move 2 weeks ago below the medium moving average, currently at 1634. Now, I did warn at the time that, and I quote, "For weeks now I've been warning that just by going sideways the market will drop below the rising medium moving average." It was the first time the market has crossed the medium moving average since December 2021. Additionally, this was also the first time the market has gone below as consciously moved below the medium moving average since June last year. Hence, I had previously suspected we might possibly see reaction to just that. Well, we had one if delayed by a few days, and that's the end of the quote. As a consequence, last week I had set aside some of the bullish ideas on the upside. So conversely, what are the potentials on the downside? Well, if we still look at the former pattern of a sideways triangle, then a primary target X would be in the 1482 area with a secondary target X1 in the 1400 even area. At the moment, the November 2012 high at 1571 and the June 2021 high at 1578 are capping the reactionary rise we've seen this week, after last week's short dip below the 2014 high at 1522. The short dip and rapid recovery was caused by the market too rapidly approaching the slowly rising long moving average below. That's currently at 1472 and taking fright at challenging it with so little ammunition. As I said last week, and I quote, "This long moving average is the main obstacle to reaching down to target X1 below in the 1400 area. There are two other factors that should be considered. Firstly, breaks below rectangles fare badly, really badly, compared to breaks above. Additionally, we also have the now strong possibility that we will have a possible monthly key reversal here. If we close next Thursday night either above 1685 or below 1620, then we'd be on." End of quote. Now that last bit on making a monthly key reversal, well, that part is still true. And right now, with only hours left to go, we are still looking at a monthly key reversal down by quite a way. Chicago soybean meal. Okay, so I've previously spoken at length about the topping action over late January, late April that turned into to be a head and shoulders top with a split head. In late April, the market breached and closed below the neckline, currently at 450.90, and triggered the pattern which subsequently fulfilled all the opportunities, primary and secondary, on the downside. Now, a significant part of the erosion of the move lower has been and still is out there. It is the market's reluctance to test the slowly rising long moving average below, currently 401.70, as well as, well, initially it was the 50% Fibonacci line of the August 21 to March 22 move at 386.80. But more recently has been the nearer 50% Fibonacci line at 400.50 of the October 21 to March 22 move. The latter had been breached but not broken during June. The major feature of this past week has been the completion of a small late May June based triple bottom with a start of a subsequent move higher. And at the same time, probably related to the break higher from this move, a break higher over the declining short medium moving average, currently 421.5. Now this break higher comes with some issues. Well, don't they always come with issues? Well, these are the issues. Immediately overhead, and possibly the reason why we have seen the reaction we have had today, is the combination of the old early April 21 high, plus congestion and highs from January and February 2021 at 433.5, as well as the March 22 downtrend, currently also 433.5. However, I suspect that this is not as impressive as resistance as my words suggest. You see, just above we have the combination of the April 21 high at 439.30, which will no doubt erode the bullish incentive quite a bit if challenged. Finally, there is a longer term pattern that needs to be considered. I described it thus. 4 weeks ago, and I quote, The second possible longer-term pattern, should it come about, may be strategically massive. It is to regard the whole action since mid-December 2021 to date as a huge head and shoulders pattern. This head and shoulders pattern has the original February to April action head and shoulders top as a crown on the large head pattern. Now, before you start jumping to conclusions, yes, head and shoulder patterns, as we have seen recently, are usually regarded as topping patterns. But, and it is important but they can also be possible continuation patterns. And continuation patterns higher in this case. And just because the last head and shoulders pattern seen here was a topping action does not mean that this larger one will be. Or in other words, post hoc ergo propter hoc. And I think it really is important to stress that point. End of quote. The neckline here, currently 398.70, is closely associated with the long moving average, currently at 401.70, and the 50% Fibonacci line at 400.50. The neckline and long moving average have been at the core of what has held up this market. I will finish with the words I ended with last week, and I quote, "Until these markets work their way through these patterns and choose which is which, then we will stay here." End of quote. Chicago soybean oil. The market made a new all-time high at the end of April. However, the peak on the last day of April was made with a bearish pattern, bearish engulfing pattern if only just. And we subsequently saw prices fall down, even gapping lower, down until just after mid-May, when they seemingly stabilized, caused by a combination of the 50% Fibonacci line of the February to April move at 75.24, and perhaps more importantly, the rising short-medium moving average, currently 77.76. Then, 3 weeks ago, on the Thursday, the market made a bearish belt hold pattern. A pattern I took pains to point out, as this is one of the most consistent daily bearish patterns available. Prices dropped lower after that through numerous supports until last week when the market met a major support and stopped falling. This was the slowly rising long moving average, currently 66.85. Even then, prices overshot lower and halted at the next support below that, the congestion at 64.84, before turning back up. The question, the market was actually below the long moving average only the one session. Thus, we can view it as a breach of the long moving average and not a break of it. Yet the recovery we have seen this week has been muted, with prices finding it hard to punch up through the wide congestion area between 68.13 and 70.33, which contains the June and July highs from 2008 as well as the June 2021 high. It is somewhat like watching a spoon going through treacle. And I suspect the force behind the spoon, to extend the metaphor, is not as powerful as is necessary to stage a significant recovery. It may well be that prices will be revisiting the long moving average and even the lows, not too distant future. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.